Hi, my name is Stephen McNamara, the founder and managing member of Horizons West Capital Partners, LLC. I want to thank you for being with us today as we introduce our new suite of strategic beta model portfolios. We think these new investment strategies, which will incorporate a specific focus on lowered volatility and downside protection, and will be invested in what we believe to be among the most cutting-edge investment strategies available today, are uniquely well positioned in the marketplace for 2015 and beyond. If you look at the middle right side of the slide, you will see our strategic beta logo. We define and employ principles of strategic beta through a rigorous focus on attempting to identify the most undervalued drivers of potential future investment return, as opposed to just gaining exposure to passive style factors, which can at times exhibit degrees of substantial overvaluation. You must remember that low-cost passive exposure to an overpriced asset is nothing more than exposure to an overpriced asset and should be avoided if at all possible. To us, strategic beta is a unique way to identify securities and structure portfolios to withstand volatile market environments, and it has nothing whatsoever to do with the meaningless term smart beta, which has been so prevalent in the financial media these last few years. As this will be a brief, high-level presentation, we will not cover all topics in great detail today. But for those interested in learning more, please reach out to us, and we can set up an individual online meeting. We will have a much more in-depth discussion about our new strategic beta model portfolios, including asset allocation weights and specific ETF security recommendations early in the new year. Hopefully, after the presentation today, which is being taped, you will have a better sense of how we define and structure our strategic beta portfolios to suit specific risk-return trade-off client requirements. For time purposes, we won't be doing a Q&A on this call, but please feel free to email us at info@hwcpartners.com with any comments or questions about anything we go over, and we will respond in short order. Before we get started, a quick word about my firm, for those who may not be familiar with us. After 20-plus years in the investment advisory business working for a number of large international asset managers, I went out on my own and started Horizons West Capital back in 2008, and we are an SEC-registered investment advisor. Our principal office is located in Newtown, Connecticut, which is approximately 75 miles northeast of New York City. You can see more of my background on our website. We essentially have two parts to the business: Horizons West Consulting and Horizons West Investment Management. Our consulting work is focused on providing advisors with our high-level and extremely cost-effective asset allocation modeling and ETF analytics advisory work in hard copy quarterly report format. Our investment management activities are centered around a series of 6 highly differentiated separate account-based model portfolios, which are currently available on a number of leading third-party platforms, including Placemark Investnet. I am going to be talking about the newest additions to our model portfolio lineup today. To learn more about any of our investment advisory services, please visit our website at www.hwcpartners.com. Now on to our strategic beta model portfolios. The underlying investment strategy to be employed by the Horizons West strategic beta model portfolios will be to invest in a diverse collection of specialized ETFs that offer dedicated exposure to investment vehicles tracking indices rearranged according to specific factors theorized to drive investment return, as opposed to those vehicles that offer rudimentary exposure to plain vanilla or simplistically passive indices and/or investment styles that so currently dominate the ETF landscape. Our approach goes well beyond the tiresome passive versus active strategy argument, and we think it is a better way to generate market-leading risk-adjusted returns, especially in a market environment characterized by uncertainty and heightened volatility, like now. Put very simply, the primary investment objective of the Horizons West strategic beta model portfolios is to generate income-based total returns over time that are substantially above other assets of comparable risk. And we will attempt to do this by incorporating a strict focus on limiting excess portfolio volatility and potential for unnecessary loss. We have 3 variations on our new strategic beta investment management concept. Our strategic beta model portfolios have been named Core Income, Core, and Undiscovered Managers in increasing order of risk. The Core Income Strategic Beta Model portfolio will attempt to generate higher levels of current income than is available through broad exposure to the fixed income market, while still retaining meaningful long-term capital appreciation potential. The Core Strategic Beta Model portfolio will attempt to generate a consistent blend of current income and capital appreciation through exposure to a roughly equal weighting of fixed income and equity-oriented securities, while at all times protecting the downside. And the Undiscovered Manager model portfolio will attempt to mirror the same strategy as the Core model, but in doing so, it will be restricted to ownership of those relatively unknown and or under-owned ETF securities with less than 100 million in assets under management. We are really excited about this model for a variety of reasons, as some of the most unique investment strategies we have seen from some of the most cutting-edge ETF sponsors in the industry exist below the 100 million threshold. We feel quite confident that this highly differentiated model portfolio is unique in the ETF strategist industry. It's very important to note that we don't think of risk in terms of traditional asset allocation exposures, meaning stock and bond allocations, when we create our model portfolios. Instead, we segment them based on embedded risk, and we define, identify, and measure risk in terms of volatility. A series of differing volatilities across multiple calendar periods and smoothed average time intervals, coupled with first, second, and third order analytics surrounding these readings. The general way to understand our approach is to recognize that risk is not necessarily good or bad. It must be analyzed in context. And if it is also not assessed within the realm of expected future returns, it is a meaningless statistic. It offers no value as a standalone metric. So we willingly seek out underpriced risk and seek to avoid at all costs those risks where we do not believe we will be properly compensated. Here is a pictorial version of our investment process end to end. In the interest of time, I'm going to touch on only a few of the process elements today. The main point to take from this slide is that our process is methodical, it's repeatable, it's highly integrated between security selection, portfolio construction, and risk management, and that it incorporates continual reassessment and reevaluation. It is very specifically not dogmatic, rigid, or mechanistic, unlike the approach utilized by a growing number of rules-based investment managers. It is the exact same approach that we utilize to create our multi-strategy hedged income model portfolios, which have been successfully managed since January 1st, 2008. Now for a little bit of heavier lifting regarding our approach. Once the general portfolio risk parameters have been determined for each one of the model portfolios, which we don't discuss in public as it incorporates our proprietary thinking, we then attempt to identify the most attractive investment strategies and or sub-strategies available for exploitation through ETFs, as our model portfolios are 100% invested in ETFs. This is done through our asset allocation process. It is the backbone of everything we do. First, we separate the capital markets into 4 high-level strategic beta-related capital allocation categories. You can see them here at the bottom. Alternative hybrid, micro or bottom up, macro or top down, and price driven. We then assign the strategic beta investment allocation sub-strategies you see here in yellow, which are generally very recognizable, into the most relevant high-level capital allocation category. What we are trying to do through this process is to identify those strategy and index weighting characteristics that we believe drive investment returns and then aggregate them accordingly. The investment strategies falling into the alternative hybrid category are pretty self-explanatory. The micro or bottom-up category houses those strategies primarily driven or best described by fundamental and or analytically derived valuation metrics. The macro or top-down category is home to those strategies primarily driven or best described by qualitative characteristics, and the price-driven category is where those strategies primarily driven or best described by quantitatively derived price analyses reside. It's important to note that our definition of what strategic beta is, and equally importantly what it isn't, very likely differs from others, but we are okay with this distinction. At present, the concept of strategic beta investing is greatly evolving, but we believe our approach incorporates the essence of the underlying philosophy behind it. And here, I would like to give a shout out to Elizabeth Kashner of ETF.com, for she was extremely generous with her time in helping to inform our thinking regarding the topic of strategic beta investing from a big picture perspective. Her guidance is greatly appreciated. Next, we utilize the Black-Litterman Protocol, an approach that has been in use since the early 1990s to estimate the prospective returns, both in an absolute as well as a relative sense, on a short, medium, and long-term basis for each one of our included strategic beta investment sub-strategies. It is beyond the scope of this presentation to get too deep into the math of this process, but to all those interested in learning more, there is ample explanatory information available on the internet. For the record, we apply a number of adjustments to the Black-Litterman Protocol to make it more appropriate for our internal use. The way we employ this protocol is very different than the way most advisors attempt to incorporate it through the off-the-shelf products currently made available by a number of marquee names in the investment world. We tested those, and our conclusion was that they don't work very well in the real world, so we don't use them. Once we have generated our return estimations for each of our available investment sub-strategies, we then identify the embedded risk of each of these capital allocation investment strategy proxies. For this, we use the same volatility assessment methodology mentioned previously. This is not a forecast volatility measure, but an actual, observable risk metric that we feel provides useful current information value. Lastly, we develop a matrix that incorporates both the calculated prospective returns derived through Black-Litterman, as well as the embedded risk measure for each of the investment sub-strategies in our working universe. We are looking for those capital allocation categories and investment sub-strategies that are currently positioned to provide the highest potential risk-adjusted future returns, which we will then use to serve as building blocks for the Horizons West Strategic Beta model portfolios. Now, once we have ranked each one of our capital allocation categories and investment sub-strategies based on what we believe to be the best, in quotes, combination of risk versus potential reward, we then go on the lookout for the most attractive ETFs within each one of the most favored asset classes and sub-strategies. For this, we perform analyses in four main areas: holdings-based, returns-based, valuation-based, and finally, qualitative analyses. It is a fully integrated security selection process. We don't talk publicly about everything we do in this area as we apply proprietary approaches to our security selection efforts. You can see some of the analytical metrics we incorporate into our work throughout this slide. All selected securities must add something meaningful to the portfolios, functioning either as current income generators, total return enhancers, risk reducers, or a combination of all three. And this contribution is not always easily identified and may at times appear to be counterintuitive at first glance. Generally speaking, the most important valuation metric in our security selection process is risk-adjusted relative yield, which gives us an opportunity to identify ETF securities that currently possess undervalued excess income-based total return potential, and therefore the potential to concurrently generate relatively lower risk capital appreciation over time to go along with the heightened level of current income. Now, on to portfolio construction. We've adopted a core satellite portfolio construction methodology when building our strategic beta model portfolios, but we take it a step further. First, if you look at the picture on the left-hand side of the slide, you will see our core satellite portfolio breakdown. We allocate 75% of portfolio assets to our core, a more thematic, stable portfolio element, and 25% to our satellite, a more tactical and shorter-term portfolio element. This allows us to not only be consistent in our longer-term portfolio positioning, but also flexible and timely when there are appropriate tactical opportunities available to be exploited in the marketplace. Now take a look at the picture on the right-hand side of the slide. Here, we take the concept of core satellite beyond what is typical, which is the key to our differentiation. As you can see, we allocate a target weighting to each one of the 4 high-level capital allocation strategies to make up our core portfolio. 15% to core alternatives, 20% to core micro, 20% to core macro, and 20% to core price-driven. It's important to note that these are targets and are not rigid requirements, so they may fluctuate through time. The remaining 25%, the satellite, can be allocated to any or all of the 4 core allocation strategies depending on relative attractiveness, or the satellite can remain wholly or partly in cash, if in our opinion there are limited excess return opportunities to exploit that fall within our allowable risk parameters. So our approach provides flexibility to adjust exposures if necessary. This is in direct comparison to most other multi-asset or core satellite type investment strategies, which are often subject to overly static rules-based constraints regarding their portfolio construction, regardless of the actual market environment that exists at any particular point in time. Now for something that is overlooked far too often. How do the model portfolios get rebalanced? Doing this improperly can destroy an incredible amount of value, so to us it is a critically important step in the portfolio management process. We rebalance each of our model portfolio components according to a very specific rationale. This rebalancing generally takes place on a monthly basis, but rebalancing may occur at our discretion in response to excess portfolio drift and/or volatility. The previously mentioned portfolio components are on the left side of the slide, and the rebalancing rationale for each is listed on the right. We typically rebalance the portfolio components either to generate income, increase total return potential, or to lower risk, or combinations of all 3. To wrap things up, we want to highlight the specific value proposition of the Horizons West Strategic Beta model portfolios. At the top of the slide, relative to bonds, the Horizons West model portfolios are designed to provide higher current income potential and much higher total return potential at comparable risk levels than other general or so-called vanilla fixed income oriented investment strategies. Now, relative to stocks, at the bottom, the Horizons West model portfolios are designed to provide higher current income potential and at least comparable long-term total return potential, and here I do need to stress longer term, at much lower risk levels than other general or so-called vanilla equity investment strategies. In short, our model portfolios are designed for those relatively risk-averse investors who are seeking to generate meaningful current income with at least moderate capital appreciation potential from their investment portfolios, but are struggling to accomplish this given the extremely low level of current interest rates available to them, coupled with the inherent unpredictability and potential overvaluation of the stock markets. So there you have it, the Horizons West Strategic Beta model portfolios. I hope this presentation has been helpful. This slide deck, as well as slide decks describing each one of our other model portfolios in greater detail, which includes specific holdings and performance, will be posted to our website shortly after the new year. If you have any questions or would like additional information about any of the topics discussed today, our strategic beta or multi-strategy hedged income model portfolios, or our financial advisor consulting services, please visit our website at www.hwcpartners.com or give us a call on 203-763-4024. Thank you very much for your time. Have a nice remainder to your day.